Hi, and welcome to IFA's Investment Showcase. My name is Maya, and I'm your host today. So today I am joined by Sid Kumar, Head of Acquisition Finance at CIP Asset Management, part of the Challenger Group. Today we'll be discussing private debt and how it has fared in what has been a particularly challenging environment, one complicated by a once-in-a-lifetime global pandemic, Russia's invasion of the Ukraine, rising inflation and ballooning interest rates, as well as a myriad of other challenges, including the increasing possibility of a global recession. Sid, thanks so much for joining me today, and welcome to the Investment Showcase.
Thanks for having me, Maya.
So Sid, just jumping straight into the questions, how did you find yourself in the private debt asset class, and what excites you most about it?
Sure. It really started from university for me. I'd always had a keen interest in fixed income courses in my MBA program, and my first job was in private debt, and that is all I've done for 15 years of my career. Mm-hmm. So I don't have a bus driver to portfolio manager story for you, but it has been the focus of what I've been doing across the parts of my career. As for what interests me about it, that's a good one. It's actually quite a long list, but if I had to pick one factor, it is in the name, private debt. Mm-hmm. The very nature of the private debt market is one where you can sit across the table from a borrower or a private equity sponsor. You can really look under the hood of the business that we're extending credit to. You can set the term sheet, you can negotiate covenants, you can agree pricing, you can really drive your investment destiny because you can tailor make the deal to what you believe it should look like, as opposed to public markets where things are presented to you on a take it or leave it basis, which is a bit less fun. So that is what appeals the most to me. And this ability to engage directly, privately with a borrower is not possible to do in public markets because it would be considered inside information. So the private nature is what is the real appeal.
It definitely sounds like an exciting space and one you're definitely thriving in. But Sid, according to S&P Global, the global private debt market has actually grown tenfold in the past decade. The use of alternative investment is increasing. What is the situation like locally, and what are some of the trends you are seeing in Australia? And are you being more careful with your investing approach in the current macro environment?
Sure. Good topical one to get into. So thanks for that. We are seeing an increase in, firstly, maybe at CIP Asset Management and part of the Challenger Group, we have been investing in private debt since 2005, and we are one of very few managers with pre-GFC investing experience. So we feel we're well positioned to observe and talk about trends in the market. In as far as what we're seeing in volumes locally, the last 5 years have seen the pullback of the banks because of a number of factors. They're increasing funding costs, they're increasing regulatory capital requirements, and lower ability to tolerate risk going forward. So all of that has meant that the share of the non-bank side of the private debt market has increased over time, and that is continuing. And we expect that will continue going forward because none of those fundamentals to do with the banks is looking like it will change anytime soon, particularly, as you said, in context of what could potentially be a recession around the corner. And the second part of it is whether we're being more careful in context of all of that. And in your forward, you talked about inflation.
All the challenges.
And absolutely, the inflation outlook, the interest rate outlook. So at CIP Asset Management, we had a pretty early read into these things coming into the back end of last year and early this year. So it's not something that we've only been focused on for the last 3 months. What we have really done to adapt our investing approach is few things. One is we have increasingly increase the intensity of stress testing businesses for their cost bases. In the face of increasing raw material and labor costs, we really want to back businesses that are able to pass those costs on to their customers without having to absorb the pain. So the defensive businesses in stable sectors, the market leaders with sticky revenues, with repeat style revenues are the ones that we've been backing over the last few months, more so than before. The other thing on interest rates is also a pretty important one, because we have been in an environment for very long. Rates have been assumed to be low forever, and that has changed a lot in the last 6 months. So things like interest coverage ratio covenants, we're bringing back in to deals that we're doing where we can get them in, and we're giving away or conceding to borrowers things like base rate floors, which in our view have less relevance going forward. And just to give you an illustration of the interest burden on borrowers going forward, our average deal is leveraged to maybe 4.5 or 5 times EBITDA or earnings, and the average interest rate that's faced by a borrower is close to 10%, because your base rate or your 3-year swap rate is 4%, and then we add a 600 basis point or 6% margin on top of it. So when a borrower is leveraged to 4.5 or 5 times and they're seeing a 10% interest rate, that's almost 50% of their earnings or EBITDA that's going only towards servicing interest costs. So that only leaves you the other 50% for the other cash requirements of the business, which are taxes, working capital, and capital expenditure. So the extent to which borrowers deleverage over time is getting increasing scrutiny, which goes back to only backing solid borrowers in non-discretionary and stable sectors. But what we're also seeing is that the borrowers we deal with, the private equity community, is quite sophisticated and is very open and awake to all of this, and they are increasingly pursuing the more attractive businesses with exactly those same positive features as well. So it's been observed across the board.
So you definitely have a thorough process of selection, but private debt continues to provide attractive yields. But how would you say that private debt portfolios are positioned in the context of what you earlier said as well, could be a potential recession in the upcoming few months or next year?
Sure. Nothing in investing is recession proof except cash, and private debt is no exception to that. But if we're considering that we're entering a period where we might be having a recession around the corner, there's certain features of private debt that make it very appealing and what you want to have in your portfolios. So the first thing is private debt is, at least Australian private debt that we invest in, is almost always senior secured. And we rarely do subordinated or unsecured debt. So that puts you in a good position in the capital structure in context of what might be a recession. It's floating rate, so you get the benefit of increasing base rates, and the duration risk is negligible compared to high yield bonds, for instance, that may be fixed rate and may also be unsecured. And almost all of what we do in the deals we do have financial covenants. There is a small portion of a covenant light element to private debt, but most of what we do has financial covenants, which gives us the necessary protections if you consider an inflation around the corner, a recession around the corner. And that's something that is not available across the board. For example, high yield bonds only have incurrence covenants, which don't really test the business at the end of every month or quarter. Financial covenants really have those teeth. So those are some of the reasons why private debt is well positioned in context of what might be a turbulent period coming across to us. The other part of your question on opportunities, it's really one where, well, we're of the view that with increasing uncertainty comes increasing opportunity as well. And with what might be macroeconomic headwinds, borrowers increasingly appreciate certainty of financing, the ability to deliver, the ability of a credit fund to say what they do and do what they say, and deliver on time, and also tailor bespoke and structured solutions that might not be available in the bank market or other markets. And the other thing is, if it's a tight M&A situation, for example, the ability to deliver in a quick and timely way to support the private equity sponsor to go through with their bid is also important to them. So these opportunities allow us to achieve an outsized premium in terms of pricing in a number of these situations, because not a lot of other parts of the market, like the bank market, isn't as competitive in some of these more tailored and bespoke solutions as well. So those are some of the opportunities that private debt brings about in context of uncertain markets.
Like we have today, unfortunately. But how have you capitalised on the COVID crisis? The private debt market appears to have weathered the storm pretty sort of successfully, at least in regards to COVID.
That's right, in regards to COVID, and that seems to be the case. So the first thing that was good about our portfolios was we went into COVID without any meaningful exposure to the sectors that were badly impacted by COVID. So we didn't have much exposure to airlines or tourism or hospitality or hotels. We didn't really, we were not even equal weight. We were pretty underweight those sectors. So we didn't see that much of a negative impact from COVID. And with the other sectors that we were invested in, even those that were significantly impacted by the lockdowns, the government response in terms of stimulus, both fiscal and monetary, was so quick and swift and intense that those businesses turned around very quickly. Some of them required covenant dispensations for certain periods of time, but that has largely performed or turned around, and most of those businesses, if not all of them, are back to where they traded prior to COVID. The other thing we did in terms of taking advantage of COVID was at the peak of market panic in April, May, June 2020, we saw that there was a lot of opportunity to add to our positions in the secondary loan market, where we bought positions from distressed sellers that either required to exit for capital reasons or required to show their head offices in New York or London that Australian private debt had liquidity. So they were required to sell. And what that means is you could buy something at 80 or 85 cents to the dollar just purely because spreads are elevated. It's nothing to do with the business. The business is fundamentally doing absolutely okay, but spreads have really obliterated valuations. So we went in and bought a lot of secondary loans in peak of COVID at the mid 80s cents to the dollar, and almost all of that has either refinanced and we've got 100 cents to the dollar back, or they're trading back up to very close to par. So this has generated pretty strong capital returns for our clients and has improved investment performance through COVID.
Now, Sid, that's very impressive, and you spoke about the Australian private debt market in your previous comment. But tell me, what is the liquidity of the local market like at the moment?
There's no getting away from the fact that the Australian private debt market is illiquid, and there's a couple of reasons for that. The scale of Australian businesses is a lot lower than US and European counterparts, so the size of debt issued is lower, so there's less debt to go around. The other reason is that the Australian private debt market has a lower share of institutional investors compared to the US and European counterparts, which are more dominated by institutional investors that are more churners of debt rather than holders. The Australian debt market tends to be, even now, bank dominated in terms of volumes, and banks typically hold debt to maturity. But the flip side of that is we price our debt to achieve an illiquidity premium. So we get rewarded for the illiquidity that we take on. So at Challenger, we aspire to get anywhere between 1% and 2% over liquid indices or leveraged loan indices in terms of pricing on our deals for comparable credits. So we get paid for it. And the other aspect of this is, while the US and European markets are meant to be liquid, they're liquid in good markets, but when you really need the liquidity, you may find that it's not available. So in April of 2020, just post-COVID, or during the GFC, there was no liquidity in any market globally for any reasonable size. So it's kind of like an umbrella that works on sunny days but doesn't work on a stormy day. So there's a little bit of that as well. And certainly in the US and European markets, you don't get paid that illiquidity when markets dry up and there is illiquidity. So in those respects, we see them as relatively comparable. Now, however, we also feel that with increasing share of the institutional investor base in the Australian market and with other like-minded investors like us coming to this market and growing their share in this market, all of us mark our portfolios to market. We've got a pretty rigorous mark to market. It may not be a daily affair, but it's at least monthly. And as that practice picks up and increases over the coming months and years, we expect liquidity to improve over time, but it's still early days in that process.
Yeah, and we spoke about earlier, obviously, and a possible impending recession globally, and rising rates and high inflation. Tell me, private debt is a strong diversifier in a portfolio. Tell me more about that.
Diversification in private debt is probably relevant in 2 or 3 levels or interpretations. Firstly, because we can be selective about which businesses and industries we're investing in. Unlike going out and buying an index, we can pick and choose what we put in our portfolios. So at Challenger, across our aggregated portfolios, we've got no industry exposure of more than 10%. And that is possible to diversify across not just industry, across credit ratings, across tenors, across seniority, across ranking, covenanted, Cov Light, a whole bunch of things. So there's diversification in a number of levels. The other aspect of private debt and how it goes into diversification is that while we may have a private debt portfolio of corporate loans, this sits alongside asset-backed securities and sits alongside real estate debt in Challenger's flagship funds. So if you invested in some of our private flagship funds, you would get exposure to not just the asset class that I look after, but ABS and real estate debt as well. So there's diversification at that product level. And thirdly, when you consider that this product is sitting in the portfolios of our institutional clients that have balance sheets of several tens of billions of dollars, a large number of them are big superannuation funds, the proportion of what we do in their global portfolios is still relatively small. So the concentration is pretty low in that regard as well. So for these reasons, we think it's a pretty good product if diversification is one of your alternatives.
Definitely. And given private debt mostly involves non-bank lenders, how are the big banks behaving? Are you seeing much pushback from the banks, or are they sort of accepting of it?
While we're seeing some retreat in terms of volumes, our approach has always been, and that has been played out for the last 5 years, our approach at Challenger has always been to not compete head on with the banks, as banks are always the guys that will have the lowest cost of capital, and competing head on is not going to be productive for us or for anybody. So for these reasons, we tend to find areas where we can do things that may be more difficult for the bank. So probably being more flexible about terms, or not being very very rigid in terms of a credit policy that a bank might apply to a particular borrower, being flexible about covenants, or being quicker than the banks, turning things around in 2 weeks, whereas it may take a bank 4 or 5 weeks to deliver a credit approval to a borrower. So we've got to find an edge that a borrower will value, that we can provide better than the bank. So that's kind of our thesis. But it's not always about competing with the banks either for us. We've found ways to partner with the banks. So there's been a number of situations where we've sat alongside the banks. So the banks have provided the senior debt and we've provided the subordinated debt in credits where we have high conviction. And that approach has worked well for the banks as well as for us, because our risk profile is a bit outside where the bank's risk profile is. We've done that. And in a lot of our unitranche deals, where the first lien and the second lien debt is one tranche, we've had banks provide revolving working capital facilities. So they do that. They provide the letters of credit to the corporate, they provide bank guarantees, they provide transaction banking and all the other things that go with core banking, while we provide the term debt. So that partnership has also worked well with the banks. So we try and find ways where we can collaborate with them where we can't compete with them. And maybe in context of this recessionary environment, or when the macro eco picture is not looking great, like even in April, May 2020, we found ways to actually provide services to the banks that help the banks directly. So an example of that is a capital relief transaction we've done with banks. We have bought portfolios of assets from banks where the banks had an outsized exposure or an overweight exposure to certain sectors that they were uncomfortable with and wanted to lighten up. We've been able to go in and take those take that risk off their hands, which helped them and us as well, because it was a quick and good way to grow assets without having to do all the work that's involved in a primary transaction. So collaborating has certainly been the approach with the banks where we could not compete.
Yeah, well, that's definitely great to hear that there is collaboration between the banks and you guys as well. But turning to ESG, that's been a very hot topic, and it's probably more relevant today than it has ever been in the past. So how are you engaging with private borrowers on ESG?
So one of the things so our mindset on ESG at Challenger is that it's quite linked to credit risk, because while we may be accepting of ESG risk now, if things don't improve from that ESG perspective, when the music stops, we're going to be holding the baby. So that goes to refinancing risk. So it's pretty linked to credit risk. So at Challenger, we have an approach where we've got a scoring system where we score every borrower on a low, medium, and high scale for environmental, E, the S for social, and G for governance risk. And if anything is high, we try and stay away. If more than one, which is two or more of those three, score medium risk, we need to have a very good reason to do the deal. But for the other opportunities, rather than walking away, we try and find ways by which when the ESG risk is low or moderate, where we can actually go in and make a difference. So that might mean going and telling a borrower, which may be in the mining services space, they might have a 30% exposure to thermal coal. So we might incentivize them by offering them a margin discount if they're able to bring that 30% exposure down to, say, 20% over 2.5 years. And the stick approach works as well as the carrot. So if they didn't bring that down, or if the exposure to thermal coal increased over 24 months or 30 months, then the margin would go up, and that would disincentivize the borrower from pursuing more thermal coal projects. So that's just one example of how we like to structure it. Rather than saying no, can we make a difference to the behavior of that borrower and reduce the ESG risk over time? It's quite a lot of ESG work that we have to do. It is getting easier now because as more and more parties are focused on it, the private equity firms that we work with are very focused on it because the managers themselves are focused on it, but their LPs are often superannuation funds and family offices who are asking the same ESG questions as us as well. So it's pretty positive that everybody has moved across the board in that one direction, and that's just made it easier for everyone.
Definitely, and we're definitely going to be seeing a lot more jumping on board that ESG train as we move into the future. But thank you so much for joining me today, Sid. It's been lovely talking to you.
Thanks for having me, Maya.
Thanks again, and thank you to our audience for tuning in. You heard from Sid Kumar, the Head of Acquisition Finance at CIP Asset Management, which is part of the Challenger Group. Thank you so much for tuning in, and we'll catch you next time.